It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. All right, thank you, me for announcing that. I got to get a new, I got to get a new open.
New intro?
Yeah, because, I don't usually hear it, but sometimes I do. And it says, it's been more than 20 years. I think we're closer to 25 years since we started doing this stuff. Radio, TV. Radio, TV.
For me, it's been
30 years.
30 years.
Well, 30 years of doing all this other stuff. But I may have to update that. It's been a few years since we've been doing this podcast, and I've had the same open. So anyway, welcome to the show. If we can call it a show, it's the podcast, Managing Your Financial Future. I'm Johnny Dean, your podcast host, not an advisor, but I'm here with Rick, the Professor Plum, certified financial planner, CFP professional, who is the advisor. And man, we enjoy talking about strategies. And at the end of last week, I said, hey, if you got any questions, just give us, shoot us an email or let us know. And we got some. And I was going to go through them. I can't get to all of them because they're different topics. But the one I wanted to talk about today, which had to do with a couple of the emails, has to do with taxes in retirement. Now, I know we talk a lot about taxes.
We talked about it last week.
We did, but it's at least if you're listening somewhat close to when we're releasing this, it's what's on people's minds.
Well, they're in the middle of tax season.
Yeah, it's tax season where we sit right now, and so which is March, and so it is on people's minds. And since I asked for questions from people and we got tax questions, I thought, well, let's talk about this here, and let's talk about. One of the things that came up last week had to do with, well, are you going to be in a higher tax bracket now? Should you take the tax deduction, the 401k now, right? Or should I do Roth and get potentially tax-free?
And what we talked about was you need to understand where you are today so you understand what it's costing you today, what you're giving up in tax savings to do the Roth or what it's costing you in taxes to do the traditional.
Which is calculatable, by the way.
That one's relatively easy to calculate versus what it's going to cost you in taxes in the future when you take the money out of the IRA.
Which is an unknown.
Which is the hard part. Or how much you're going to save by not having to pay taxes by taking money out of the Roth account when you're in your retirement years.
Yeah.
And that is a projection into the future based on data that is not known and also data we know is going to change.
Well, that's true, because if you're making investments in your 401k, presumably it's for the long term, which could be in at least 5-10 years or more.
Right. And even if you're retiring next year, the money you're saving this year is probably not the money you're going to be withdrawing next year.
No, it better not be. If it's
or
in
you
your
got
401k.
Unless this is a brand new job you're only doing for 1 year and you've got the rest of your money tied away somewhere else.
Well, okay, that's
true.
But
even then, this is money your dollar cost averaging should be long term.
It's got to be. This is money you should not need in your 401k for at least 15 years, let's say. All right, so as I looked around online, and of course, the internet always gives you accurate information. I found not a consensus, but I did find that many, if not most, articles out there suggested that your taxes are going to be lower in retirement than they are during your working years.
And I believe in many cases that is true.
Well, in many cases it is. Now, the reasons they cited were fairly obvious, which was that, well, you're not working anymore. So you're not, you don't have an income from W-2. So maybe you're living off of your savings. Maybe you're living off your investments and all that stuff. Generally, people's incomes, I won't get into it.
And it also comes down to, are we going to be talking about your overall taxability?
Yeah.
Or the marginal, the cost of that last dollar of income you showed on your return.
Right.
And so that has a difference as well, because in reality, let's say somebody had a $100,000 income before retirement and they have a $100,000 income in retirement, just so happens. Is their tax bill going to be identical? No, it's not going to be identical. It's going to be overall a little bit lower because presumably for the people out there, some amount of money in that $100,000 of retirement income is coming from Social Security, which at currently the worst case scenario is only 85% of it, because 15% of it's tax free. Yeah. 15% of your income wasn't tax free.
In the worst case scenario.
yeah, that's the worst case. It could be less. So, and how much of my Social Security is taxable depends on where that other, in this example, $50,000 of income is coming from. Is it coming purely from IRA? Is it coming from pension? Is it coming from taxable sources? And if so, then a big chunk of my Social Security will be taxable. If it's coming from I'm living off of personal investments, I've got $1 million bank account, and even though right now bank accounts can actually earn something, they're earning $30,000, $40,000. Okay, but as I draw that down, it won't be earning as much. But that's still, I'm taking 50 out of it, and I only earn 30, 40, so I got less taxable income there.
Yeah, so it would stand to reason that for that reason alone, that perhaps somebody should be in a lower tax bracket when they retire. So is that a good rule of thumb for somebody to make that assumption, which would say that, well, why would I pay taxes now? Why would I ever do a Roth?
You're going to get tired of me saying this, but the answer comes back to it depends on who you are. It depends.
Yeah.
If you are somebody who has a very large amount of direct income, pension income, and things of that nature, and most of your savings is in IRAs and things, and you're looking at your income, and your income in retirement is going to be higher than what it is right now. I should say taxable. Right now, you may be making that $100,000, but you're putting 30 of it, because that's what we're allowed to do this year, into a 401k. And you have to pay some Medicare expenses, things like that. So your taxable income, your taxable gross income, is only $65,000 out of that 100.
Yeah.
So what are we actually doing as far as taxable income? Most people are going to be slightly less.
You mean most people will be in a slightly lower?
Slightly, but I don't think they're going to be dramatically less, unless you're in an unfortunate situation where you just never had the opportunity to save. And then if that's the case, you'll probably be in a much lower, because the only income you'll have is Social Security or close to it. And if that's the case, you're not going to pay taxes.
Well, and that's the other thing too. If all they have is Social Security, the way it's set up, no matter how much money in Social Security you make, it will not fall into the taxable column at the end of it.
Once it's all said and done,
yes.
The deductions are taken, and I think even if you had two extremely high wage earners that never saved a dime, and so they retire and they're getting $100,000 a year, they both waited until 70. They're getting $100,000 a year. Yeah, they're not going to pay taxes on that. If all of it is Social Security, it's not taxable yet.
Could you get $100,000 at this point if you waited till 70?
Two people.
Yeah, that's what I mean. Married couple.
Yeah.
Wow, really?
Yeah.
I guess I haven't looked at it for a while.
Yeah, for a high wage earner that's maxed out for all their years.
So what's the top?
It's 4,300 or so. I'd have to look it up for sure, but
if
it's
you
in
wait
the
till
4,000 per month area. It's
wow.
not like 4,900 a month, but
no.
I think 4,400 maxes it out. I can look it up in a minute. Where's your tax sheet? Come on.
No, you're always, here we go. Right here. You know right where to look. It's a nice laminated sheet, by the way.
Jeez, who would do that for you?
Professor Plum, you actually take these tax sheets and you go home and you iron them, right? On the and you laminate them.
I have a lamination machine at home.
Yeah, I've seen you do that. Sure.
Wrong.
You put the apron on. What do you see there? Have you found anything? We're looking to see what the highest Social Security benefit is. And now, Professor,
if you wait until 70.
If you wait until 70, did you get the highest full retirement age benefit?
Yes.
Which is what?
$3,627 if you retire this year at full retirement age.
Okay, so this year $3,627 would be the highest you could get.
So that would mean somebody was born in if they were 66,
if they're how old?
That'd be. Yeah.
66 would be 1957 this year, if they're 66 this year.
Yeah, so the max is in the 4,600, high 4,600 range.
Wow. Now, you got to be making an awful lot of money.
Well, you've got to max out.
Throughout your 35 years.
Yeah, for over 35 years, yes.
Yeah.
But if they worked until 70, they could have started maxing out at 35.
It's a pretty good. It's pretty good.
It's a pretty good run.
So what that tells me is that even if you just had no other savings, you had a great income, but you spent it all, and you just had Social Security, you will not be taxed on that. So that's somebody who is a lot less in retirement, tax wise.
Oh yeah,
I mean a lot.
But it's unlikely you have two people who maxed out their wage-based earnings for 35 years and didn't save any money.
I could see it though. You spend it making 200 some odd thousand a year each, and
for two people to max out their
it's
wage
unlikely.
base this year.
No, I know it's unlikely.
$324,000.
There are people out there who can spend that much.
Well, I've talked to other people. I've known people who are very comfortable. That live on $50,000 a year, work and make $50,000.
Yeah.
They've learned to live within their means. And I've met some people that make over $50,000 a month and can't find two nickels to rub together.
Yeah, it happens.
It's all a matter of how it's lifestyle.
But what this tells people still is that, well, gosh, I mean, the odds seem to be in favor of me being in a lower tax bracket when I retire.
For most people, I think
so.
Especially if you look just at the marginal brackets.
So if it's lower, this comes back to our sort of ties into last week. If it's lower, then why would I ever do a Roth?
Well, the biggest motivator is I hate taxes today, and I'm going to get that tax deduction today.
Well, that's what I mean. Yeah.
That's
why would I not do a Roth? Why would I ever do a Roth? Because I have to pay taxes today. When when I take it out when I'm retired, I'm going to be in maybe a 12% bracket as opposed to a 22 or whatever I'm in.
But we run into the unfortunate instance that 12 isn't 12 all the time. This is where math, gets funny.
Mm-hmm.
I mean, the math is true, but when we talk about the 12% marginal income tax bracket, that's for a married couple right now with taxable income up to about $80,000 or give or take. I can't think anymore. 88,000, almost 88.5.
Wow.
So if your taxable income after all your deductions, everything is under $88,450, you're basically in the 12% income tax bracket for the majority of that $88,000. So the problem is, what if my gross, this is where it gets complicated because there's gross income, there's taxable income, and then there's Social Security. Because in reality is, let's say I'm at $60,000 and I say, well, I could take another 10 out of my IRA and maybe convert it or spend it, whichever you want to do, but taking it out of the IRA. So that adds $10,000 to my tax return. Well, I've done my taxes already. I know that I've got $60,000 of taxable income after all my deductions. So if I take another 10, I should be at $70,000 of taxable income, because 60,000 plus 10.
Yeah.
But in the taxation world, especially where you have a decent sized Social Security, 10,000 equals 18,500 in some cases.
And don't ask why, but it does.
Because that $10,000 that I took out of my IRA then subjected another $8,500 of my Social Security, which previously wasn't taxed, to taxation. And so while I'm still in the 12% bracket, even with that extra $18,500, that $10,000 cost me a little over 20% in taxes.
Yeah, and that really takes people by surprise.
And it stinks. And the other side is, maybe I'm in the higher brackets, and I'm closer to 200,000 in before and after.
Mm-hmm. I'm
going to be in the 24% bracket, assuming those brackets even stay with us. They may be higher in the future. I doubt they'll be lower, but hey, you never know. And now I'm going to be bumping up, at least in today's environment, against the income-related monthly adjustment amount for Medicare premiums.
The dreaded IRMA.
So while my tax bracket doesn't change, there's a big area of the same bracket in that my out-of-pocket taxes do change when I have to pay more for my Medicare premiums.
It's just a big mess. Or let's just say it's convoluted.
It's a complicated mess.
It's complicated, and but it's complicated for a reason, because there are just too many moving parts.
But it's not just complicated in that area, because we also have to deal with, for many people, state income taxes.
Yeah.
And what state do you live in? A state like Pennsylvania doesn't tax retirement income. You have a pension, you take IRA distributions, Social Security, not taxable. Capital gains, interest, dividends, and things like that are still taxable. But, you may be working and you get a pension and you start taking money out. So you were working, in a neighboring state that had a relatively low, but some kind of a taxation. And then you move to Pennsylvania and you're going to be in a lower tax bracket because your income is not, and once you retire, is not taxable. So you went down, whatever that percentage was.
Sure.
Now you got to live in Pennsylvania, which is a beautiful state, but it can get cold.
Once in a while, the winters.
Yeah.
But especially for people with California blood like we have.
And that also, we had an email a little while back about what is the best state to retire in. And it's different. We can talk about the best state from a tax standpoint. Obviously, there are certain states that have no income tax. Nevada,
well, from an income
Washington,
tax standpoint,
but then Texas, but then Florida, but then maybe they have property taxes that are more than where you were used to, or maybe they don't have the infrastructure. Maybe they don't have the sites, the things to do, the hobbies that you want to deal with. So what the best place to retire, what state is the best place to retire in, depends on a lot of factors, one of which is taxation. And so I mean, obviously, if you want to know what the best state to retire from a tax-free standpoint is, look at the states that don't have an income tax, and then look at the sales tax, and then look at the property tax.
Well, what you got to do is you have to look at, okay, there's no income tax, but where are they making this up? Where are they getting this from? Now, places like Alaska, they don't have a state tax. They have a state tax?
I don't believe they do. They actually pay residents.
Yeah, they do.
The permanent fund.
But you got the oil stuff going on there. Texas has the same thing, but they also have to make up for it in things like property taxes. I know in Texas that there's an issue with that. Every state has to make it up in some way. Nevada has, at least for now, the gambling industry holding it up, and I assume that will continue for a while. So that is a big subsidy.
Yeah, I don't see gambling going away anytime soon.
Well, I don't, but they had real problems, which we saw during COVID, and casinos closing, not permanently, but temporarily closing. But these are the kinds of things that you have to consider if you're saying, well, what state do I want to move to? Because I would like my taxes to be lower in retirement. I think it was. You sent an email. Was that Kurt? I saw an email from, I think his name was Kurt.
Yes.
Who said
a longtime listener friend? Yes.
Okay, all right. You had that printed. He said move out of California.
Alaska does have an income tax. They don't have a sales tax.
Oh, okay. All right, they do have an income tax. I didn't want to say they didn't, but anyway. But Kurt brought up a good point, which happens to be that one of the things you have to consider when it comes to taxes and retirement is where you're going to live. As you said, some states don't tax pensions, some do, some don't tax.
And so, if
Social
you're looking
Security.
at the state, like all you did was, Google Pennsylvania's state income tax rate, you would get a series of income tax, or maybe it's a flat tax. I don't remember that one, but they don't tax retirement income. So you would get, unless you Googled further and knew what question to ask, you would think, oh, that tax rate is X. Well, it's not X when it's retirement income. So you have to understand where the income is, and you also then have to look at the things that the state offers. California offers a lot of outdoor activity, a lot of things. It has a lot to offer. And it also offers you a really high state income tax, which is one of the reasons to get the heck out of it. But there's a lot of reasons to be in it. So you have to weigh those factors against each other.
Yeah. I mean, you can't just really look at it in a vacuum. Any state really with a high population, and California has 3 very high population density centers. One in the south, one in the semi-south, and one in the middle/north. So when you have that many people living there, it's expensive to take care of roads and bridges and
I was
take care of all the people.
I was driving in on the state highway this morning.
Education, yeah.
Okay.
No, I'm just saying.
I was driving on the state highway, and they ain't taking care of the roads. We just had a
No,
rainstorm.
it's still a
Yes, it
problem.
does rain in Southern California, and we're in Southern California, and we had a pretty good rainstorm, a lot of wind, and man, there were, for whatever reason, just today I noticed some big, like 12, 18 inches across, 4 or 5 inches deep potholes on the state highway.
Well, that's, and people squawk, well, I don't ever raise my taxes, but when you have a big state with a lot of, with a high population, these are the things that are going to happen.
You're making excuses for California wasting money everywhere else.
Well, I don't know if they're wasting money. I honestly couldn't tell you if they're wasting it. Any money they spend is good for the economy. But the point is, this is what you're going to get. So you have to weigh that. You say, well, I can move to a low population state where there really isn't a whole lot going on. You can. I don't know what the lowest are, but
probably Wyoming.
Maybe Wyoming.
One of the lower ones.
Kentucky, one of those, and I'm sure people.
I've heard of Wyoming being one of the better places from a financial standpoint to retire, but it can get really cold there too. Beautiful areas, but. Wow, it can get cold.
Well, every state has to make their income somehow.
Yes,
and that's just the reality. I don't want to get into too much, which state is the best to retire.
Your state income tax has a lot to do with what your retirement income is going to be, which goes back to last week's discussion of whether you do Roth or traditional type retirement accounts.
Yeah. Are you going to stay in the state that you're in? Now, a lot of people do. It seems that you've got a choice if you're retired. Some people like the sun and they live in California where they pay a relatively high income tax, or they like the sun but they don't mind the alligators and all the other stuff, and they move to Florida where there isn't an income tax. But again, even in Florida, they make it up in other ways.
Yeah.
So, you can pay through, your tax form, or you can pay through another way. But it's all part of this. It's all part of this game that you got to play, Right. But the backing up to the main point of that, which was that you said, is that it's where you retire is going to play a factor as to whether or not you're going to have a higher tax rate in retirement
To some
or
degree,
lower
yes.
tax rate in
Where you
retirement?
retire, where's your income coming from in retirement? How do you structure it? And if you structure it incorrectly, you could be in a very low income tax bracket for a little while, then a very high income tax bracket for the rest of your life.
Any quick tips for people that want to perhaps lower their taxes in retirement?
Well, take the steps to find out what your tax bracket is today. I mean, a lot of people complain about the taxes that they have, but they're not aware of what taxes they're actually paying. So find out. If you're going to complain about it, know what you're complaining about.
Well, like what? Am I putting you on the spot?
I was talking to somebody, and they were complaining about the taxes they pay, and they had a household income of about $80,000, and married couple, their income tax bill really, as a percentage of the overall, wasn't what I would consider to be very high. Obviously, they didn't like it, but they also had been doing everything they can for years to save money to do that 401k, and so when they retire, they're going to be in the same or higher overall amount of taxes paid in retirement.
So they're not retired now.
They're not retired yet. They're still working, but they're getting ready to retire.
Well,
and they're looking at retirement. Their income's going to be more. They're thinking, oh, this is going to be great, but their expenses are going to be higher too. Not from fun, from taxes.
Well, yeah, and what happens is, and this is a very common scenario where people, in some cases, most of their retirement is in a tax-deferred account, like a 401k, right?
That's not uncommon.
You have a husband and wife been married for 30 years, 35 years, 40 years, something like that, and they've always had a 401k, and they've been always putting money away. Now that money got tax deducted going in, right. But of course, once they take it out, when they retire or when they reach RMD age, whichever age that happens to be, that's where the tax bills are going to start getting hit.
It's interesting you say it that way, whatever that means, because it is different
depending
upon when you were born.
We used to be able to say, once you hit 70 and a half, my friend.
And then for a while, very short while, 72.
72. Okay, well, we'll make the adjustments. It's age 72.
And now
it could be
73
or
if you were born in 1951 through 59. And if you're born in 1960 or later, it's 75. Of course, that's still a few more years away, so they could change it by then. I don't think they will, but who knows?
I don't know.
So
but
depending upon what year you were born, kind of like what's your full retirement age? Depends on what year you were born. We have to get used to what's your required minimum distribution age. Depends on what year you were born.
Yeah, it turns more and more complicated as we speak. So the idea that your taxes
tax simplification.
Well, I know. I don't know that I want to simplify tax.
The more we scream for tax simplification, the more we get this.
I don't necessarily want tax simplification.
Well, I want to be able to basically put a lot of people out of work if taxes were that simple.
Well, in a way,
put me part of my job out of work.
Well, yeah, but I mean, if there's a way that I can, that I can do a strategy that's going to lower my taxes, I'd like to be able to do it.
That must be a loophole that we've got to, that's bad if you take advantage of it. It's good if we take advantage of it. It's bad if you take advantage of it.
You could scream that all day long. The things you can do, though, to lower your taxes. Now, you talked about people who have put their money away in a 401k for many, many years. Now, they're in their 60s, let's say, and they're thinking about retiring soon.
So now is 100% of the money in the 401k, or do they have personal money? I have I'm talking to some people, they've got some money on the sidelines, and they've got the ability to live off of personal money for the next 4 or 5 years the first 4 or 5 years of retirement. And they're not going to be getting any Social Security yet. They're going to be living on personal money, which means they're going to have very little taxable income because the personal money, maybe they got $1 million in cash that earns $40,000 a year in interest if they've got it in laddered T-bills, but $40,000 a year when they've got that kind of a portfolio, several $1 million portfolio, isn't that big of a point.
Right.
But they're doing this and they're living off of that 40,000, and what they're going to do, or they're living off of more than 40,000, but they're being taxed on 40,000. They're going to do conversions over the next 5 or 6 years, taking them right up to the top of the 12% bracket. They're contemplating using some of the 22% bracket as well, or even big chunks. It's just a matter of how much of a check they want to write. They're going to start converting because even though they have a good sized personal account, they got a bigger tax deferred account.
Yeah. Yeah. Well, this is where people need to start thinking about things like this.
And so they're actually going to pay some taxes today that they don't necessarily have to pay.
Yeah.
To avoid paying a lot more taxes 10, 12 years down the line, 13 years down the line now. You got to get used to the new math.
Yeah. Yeah.
Than they would do if they just went really low for a while.
This is why tax management becomes so important, not just once you're, maybe once you're retired, but well before you turn age 73, 75, whatever. the longer you defer taxes, the more somebody's going to have to pay at some point.
Yeah. And the problem with an IRA or 401k, the traditional side of the house, somebody's going to pay those taxes someday, because
either you or your heirs.
Your heirs. It's either you or your heirs, or your surviving spouse. That would, I think, be the worst of the three options.
Well, what happens when a spouse passes away?
Well, I talked earlier the fact that we could have about $88,000 of taxable income as a married couple filing a joint return, and stay in the 12% bracket. That's after all the deductions, the standard or itemized deduction things.
That's
like
a married couple.
That's the 12%, the top of the 12% tax bracket. The top of the 12% tax bracket for a single individual is $44,000 and change. So if they have similar income after somebody passed away, obviously they're going to lose a little bit of income from Social Security, and they may or may not have maybe they lose some pension income. But a lot of people have their income goes down some, but it doesn't go down by 50%. Sometimes they do, but they're going to be in a higher tax bracket. The survivor is in a higher tax bracket because maybe they had $88,000 of taxable income, which meant they had about $120,000 or so, $115,000 of gross income. And their income maybe drops to $90,000.
You mean if a spouse passes away?
It drops to $90,000 after a spouse passes away. That means a big chunk of it is going to be in the 22%.
Yeah, because you're now single.
Because you're now
single. So these are the things that you got to look out for. But very quickly, we only got a couple minutes left. Is there anything that people... We talked just a second ago about what people can do to potentially lower their taxes. One of those maybe pay some taxes now in a certain bracket, depending on where you are.
Pay attention to when you start your Social Security and use those years that you're not taking Social Security but you are retired to do conversions. Look at how you're doing and maybe start building some Roth now if you're looking at, unless you have very similar income and you're going to be in the same or lower bracket. Understand where your brackets are. And if you're close, start building up some Roth now. That would give you, the thing is, a lot of people know what their income is expected to be in retirement, but every once in a while we all get a little, got to buy something.
Yeah.
And we need a lump sum of cash.
Things happen.
A roof, of this, of that, and we don't necessarily always want to borrow to do that and stretch the payment out if we just want to pay cash for it. But then we look at all of our money's in an IRA, and if I pull another $20,000, $30,000 out of the IRA, it's going to cost me a lot more in taxes. Having a tax-free account to be able to pull from can really be helpful. It can give you flexibility. It doesn't mean you have to use it, but it gives you options.
Yeah, and anytime you've said this many times, don't waste a good tax bracket. Don't waste the 0%. Don't waste even a 12% if you're 10 or whatever.
Yeah, and if you're lucky enough, don't waste the 22 or the 24.
Yeah, yeah. So if you need help with this stuff, I would advise you getting in touch with our Professor Rick Plum at Lucia Capital Group. He oversees all of the plans that go through the Lucia Capital Group system, and as Chief Financial Planning Officer, that's your job, Professor Plum.
One of them.
One of them, yeah. But it's a big one. 800-644-1150. You can call the folks at Lucia Capital Group and get your plan started. If you've got tax issues that you're concerned about, if you've got a lot of money sitting in your 401k and you're thinking, oh, man, looks like I'm going to have to pay the piper or somebody will here at some point very soon, maybe there are strategies. In fact, there are strategies that you can employ. 800-644-1150. Or go online, luciacap.com. You can find as I say all the time, blog posts, videos, maybe even some snippets of this show. Go to luciacap.com, luciacap.com. Also find us on Spotify, Apple, and all that stuff. Subscribe to our podcast. Do not miss a single episode. We got one more episode in this season. So Professor Plum, next week,
the finale? Season finale?
Yeah, if you want to call it that. Then we'll be off for a couple of weeks while we regroup and get some new topics. We still have some emails we didn't get to. I had one from Clem in Utah that had to do with some forms. We'll have to see if we can get to that.
Is there any legislation pending so we can have like a cliffhanger at the end of the season finale?
I'm looking for that.
Wait until next season when we get the answer to what the IRS or Congress is actually doing on this.
Yeah, we got an answer. And you know what it is?
We'll tell you next time.
Coming up in 3 weeks.
It was a dream.
That's right. We're going to use the old trope, aren't we? Okay. So that's it. That's all. We're out of time. How about that? Professor, thank you so much.
You're welcome.
We got more coming up next week. And don't forget, as I said, to tune in and subscribe to this podcast. Tell your friends. and neighbors and all that stuff. Let them know we're here because we helped you. We can help them as well. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks so much. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.